and welcome to this programme from Baillie Gifford, the latest in a series of webinars where we talk to the managers of the business's investment trusts. My name is Danielle Levy, and today I will be talking to Helen Xiong, co-manager of Monk's Investment Trust. We will be talking about how she runs a portfolio and where she's seeing opportunities. Helen, welcome, and thank you for joining us.
Thank you. I'm happy to be here.
So you've suggested that markets could be unpredictable given we have higher interest rates, tariffs have increased, populism is on the rise. So how do you plan to navigate what could be challenging market conditions?
I think navigation is probably the right way to think about it. I mean, like sailors, we don't control the weather or the tide, but we have to steer the ship or the portfolio, in this case, to a happy outcome. And I think there's really two parts to it. The first is we want to be aligned with the long-term structural drivers of the economy. So whether that has been the growth of the digital economy, AI, robotics, automation, etc., because those drivers are the engines of wealth creation and they're independent of, say, the GDP, interest rates, etc. So if you go back to the navigation metaphor, the weather changes, but we want to ride the tides, and it's the tides that will remain constant, the currents. The second thing I think is we want to build resilience. I think it's important to lead with growth, but we don't believe that growth has to come at the cost of fragility. We build resilience through having uncorrelated growth drivers. So yes, we want lots of exposure to AI, but we also want companies like Games Workshop that sells minifigurines, or Ensign, which operates skilled nursing facilities and have absolutely nothing to do with AI, but are fantastic businesses in their own right. So really, I think going back to, how do you navigate uncertainty? We do that through trying to balance both growth and resilience.
Great. And US market valuations are high relative to history. Should investors be concerned about the trust's high US exposure?
Right. So there's two parts to that question. I think in terms of US valuations, it is true that the PE multiple of the US market is looking high relative to its long-term history. I'm not quite sure if the conclusion is therefore the US market is expensive, because I think there has been a mix effect as well. So what do I mean by that? The US index is more concentrated than it's ever been. Around 40% of the S&P 500 is in the top 10 companies. And that's very different to, say, 20 years ago, when the largest companies were still, the index was relatively flat. And the largest companies were relatively mature companies that suffered diminishing returns to scale. Now, unlike then, these companies are giant companies that are still growing at double-digit rates. So, Microsoft grew at 17 to 18%. Meta saw accelerating growth at 26%, and NVIDIA had 94% year-on-year growth in the last earnings report. So these companies rightly trade on multiples that are a little bit higher than the average of the market, and it's probably well justified by the growth rate and the quality of the business, and they represent a bigger proportion of the index. So I think that has to be taken account when looking at sort of the spot US multiples. I think the second part, in terms of our current exposure, just under 60% of the trust is invested in US companies. Now that's actually underweight relative to our index. It's a 9% underweight to our index. So we're less exposed to the US relative to the benchmark. And part of that is, we don't invest to a specific outcome. We just try to follow our enthusiasm and where the most attractive growth companies are. And we are seeing more valuation opportunities elsewhere, such as emerging markets, for example.
And if we look at the management of the trust, so your co-manager, Spencer Adair, is retiring at the end of March of next year. You'll continue to manage the investment trust alongside Malcolm McColl, with Michael Taylor joining in April. So it'd be good to understand how you're preparing for Spencer's retirement, and will there be any changes to the investment process?
Yeah, so no change to the investment process is the short answer. So Spencer has been with Bailey Gifford for 26 years, and he's retiring after 26 years with the firm. Mike joined as co-manager or will join as co-manager in April. The trust has always been managed jointly by three portfolio managers. That was Malcolm, Spencer, myself, and on an ongoing basis, it will be Malcolm, Mike, and myself. So really no change.
Great. And you have diversified growth engines across the portfolio. So it'd be good to hear a bit more about why that's important in today's market conditions. And secondly, if you could talk us through the three growth profiles in the portfolio, which I understand to be stalwart, rapid, and cyclical. So also if you can provide any examples as well in those categories.
Yeah, very happy to. So I think what having a diversified growth engine means, in effect, is that we cast the net wide, right? We want to own exceptional growth companies, but we are not dogmatic about what growth looks like. We believe companies are exceptional in their own ways, and exceptional growth companies can come from across the different industries and markets. So I think there's really two advantages of this approach. The first is that by casting the net wide, we give ourselves the best opportunity to capture growth from really across the market, some of which may be from sectors or industries that may perhaps been overlooked because they don't fit the traditional mold of what growth looks like. So to give you an example of that, FTAI Aviation would be one example. It's an aircraft engine leasing and MRO company. So MRO is maintenance, repair, and overhaul. What they do is they buy worn out aircraft engines at bargain prices. They give it a facelift, and then they either sell it for a profit or they lease it back to the airlines. That's a very, very esoteric business. But when we look at the business, we think there's a path for it to becoming a much better business. It's becoming a lot less capital light than it has been historically, and that's reflected in the margins and the return profiles, which are going up. And we also see a path of it going from, say 5% market share, which is what it has now, to 20% market share. So I think the second advantage is that we've got the three different growth profiles. And we found that over time, companies in these growth profiles tend to outperform in different macroeconomic conditions. Rapid growth stocks tend to do well and poorly at a similar point in time, but cyclical stocks or stalwart stocks do perform differently. So by having different and uncorrelated growth drivers, that gives the portfolio a level of resilience that we wouldn't be able to replicate if we had a single flavor of growth. Now, as to what they are and some examples of them, so stalwarts are the get-rich-slowly type of companies. So it's companies like the MasterCards or the Disneys of the world. They are established, they are durable, and they are self-funding businesses with very deep moats. There are typically companies you'd be happy to own in most macroeconomic environments. They tend to grow their profits fairly dependably at 10 to 15% for a very long period of time. The rapid growth companies are the disruptors. They are companies like DoorDash, the food delivery company in the US. They're faster growing. They are either challenging the incumbents or creating new markets through new technologies or business models. Typically, these are founder-led with very ambitious visions. And what really matters here is execution. And thirdly is the cyclical companies. These companies tend to be the more mature companies. They are capable of double-digit growth over the long term, but that growth is not delivered evenly because they happen to operate in cyclical industries. They are prone to capital cycles, and we do expect periods where profits will fall. What we look for is management teams that keep investing during those difficult periods so that when the cycle turns, the company is set up for an elongated period of growth as it takes share from its peers. So a good example of a cyclical company would be Ryanair. They placed very large aircraft orders from Boeing during the COVID period where everyone was canceling their orders. they didn't reduce their staff like every other airline did, which put them in a very strong position to take market share when travel normalized.
Great. And the valuation premium of the portfolio reached a historic low recently, and that was relative to the broader market. Be good to understand what the significance of this is and what it indicates about the portfolio. And just to clarify, the valuation premium is the excess an investor is willing to pay for a company's shares versus the market.
Yes, so the valuation premium in this context is the PE, the PE premium that you pay for the portfolio relative to the benchmark. And just to be clear, we are a growth portfolio and we've always been comfortable paying up for growth and quality. And throughout the history of Monks, it's always traded at a valuation premium. However, as you noted, Danielle, that premium has fallen quite rapidly in the last couple of months from over 20% to what would be considered more normal to just over 10%. But I think what's really interesting and why it's sort of significant now is that it's come down not because we've lowered our growth ambition or we've lowered our quality hurdle, but it's come down despite the forward-looking growth expectations for the portfolio still being much, much better than that of the benchmark, as well as the quality metrics, whether you look at the profit margins, the returns being much higher or the debt levels being much lower than the benchmark. They are as strong as they've ever been. And I think that hopefully sets the portfolio up well to deliver future returns for shareholders.
And you've spoken about the importance of cultural resilience and flexibility across companies in the portfolio. Be good to hear some examples of this.
Yeah, so a good example of this is Shopify. Right, so Shopify really started out as selling snowboarding equipment online. Very quickly, they realized that the market for snowboarding equipment is actually quite limited. This was a long time ago, a decade ago. But they built up a lot of technology that enabled them to sell things online, which at that time was novel and in demand by a lot of small companies. So they pivoted the company to selling sort of the technology that enabled them to make transactions online to small companies. As they helped serve a lot of these smaller merchants, they realized that actually these merchants don't just want to sell on their own website, but on Amazon, Etsy, etc., multiple, and some of them offline as well. So they built up all of the tools for that. And then those small merchants became large merchants. So they built up the tools to serve the large merchants. And, a couple of years ago, they went all in on logistics. And very quickly after that, AI came along and they made a very strategic pivot to say, logistics isn't really the most valuable area we could spend our time right now. And that they went all in on AI. So that's an example of a company that is really adaptable, is really open-minded and flexible in how it thinks about its business. And what it's really good at is sort of pivoting and taking advantage of the changes that they see.
And earlier this year, you decided to move away from companies where the investment case relies on high levels of discretionary spend. So what was the thinking behind that decision, and which companies did you sell out of? And I guess an obvious kind of follow-up is also, where did you recycle the cash? Where did you invest?
Yeah, and I think that goes back to trying to build resilience. We want to own companies where the investment hypothesis relies mostly on things that are within a company's own control. So we call that internal drivers of growth, right? So whether it's innovation or self-improvement or consolidation through M&A, etc. We felt uncomfortable owning companies where the main thing that matters is macro, or sort of where the investment case can be significantly derailed by a change in the external circumstances that are outside the control of the company. So we exited a number of companies like Norwegian Cruise Lines, or Yeti. And at the same time, I have to say that in terms of where we recycled the capital to, it's really been very diverse across the three different growth profiles. We haven't seen a very strong theme. If I were to pick out a theme, I would say that what we've seen in many markets outside the US, let's say Japan and Europe in particular, is that there's been a very strong rally in value companies, really poor quality companies that are not growing very quickly. And as a consequence of that, that's been giving us opportunities to buy high quality growth companies at really low multiples to their historic valuations. So companies like Games Workshop, which is a UK company that sells minifigurines. It owns the Warhammer franchise, or MSCI, which is really a royalty on the financial markets, or even Keyence in Japan, which is a factory automation company.
And why do you think AI could prove to be the most significant engine for portfolio growth over the next decade, even potentially surpassing the internet boom?
So I want to say that comment is not intended to sort of poo-poo the internet boom. I think the internet has sort of fundamentally changed how society operates, from how we consume entertainment, how we interact with each other on social media, or how we shop. But I think if you look at the internet, what it really changed, retail, advertising, media, entertainment, and travel. And if you add all of that up together, I think most people would say that sort of the digital economy is around mid-teens% of the global economy. That's the part of sort of the global GDP that has been touched by the internet in some way. And I think AI has the potential to touch a far greater proportion of global GDP. So it's got the potential to touch all of that we just mentioned that has been affected by internet, but also autonomous driving is probably one of the first real world applications of AI. But if you think about the potential for AI to improve drug discovery in healthcare, the applications in education, or really manufacturing with robotics, we are at the very early stages of that. So I think AI has sort of the potential to connect the digital economy to the real economy, if you like, and I think that will ultimately be bigger.
And when it comes to accessing AI as an investment theme in the portfolio, you've spoken about having an intentionally wide exposure to companies that power, build, and benefit from AI. So what's your thinking about having this broad exposure, and can you give us some examples of the types of companies you hold?
So the reason for having a broad exposure, I think that really reflects the early stage we are in with AI adoption. I know there's lots of people that is worried about is this market getting too heated? Are we in a bubble, etc.? I don't really believe that. I think it's really too early to be certain about the potential winners. The landscape is changing very quickly. So we want broad exposure, whether it's to semiconductors, the equipment makers, the data center operators, the application winners. And if I was to pick out a few examples of each of those, so obviously the semiconductors, the NVIDIAs and the Samsungs, then we want companies that make those semiconductors, so the TSMCs of the world. Then companies that make the machines that TSMC uses, so the Discos, the Kokusais, or the ASMIs. And then you go to the companies that buy those semiconductors, so whether it's the Metas, the Microsoft, Alphabet, etc. The companies that build the data centers for those hyperscalers, so Eaton, the power management company, or Comfort Systems that does the cooling systems for AI data centers. And then you go to the application companies like AppLovin or the Salesforce that's helping enterprises adopt it. And then you can even go down to the service companies like EPAM, which is an IT consultancy, but it's really a leader in helping enterprises with their digital transformation and AI adoption.
And NVIDIA is your top holding. It'd be good to just discuss your outlook for the microchip manufacturer and your thoughts on recent share price weakness or volatility.
So I think the recent share price weakness is more narrative than fundamentals. I think the narrative around AI runs hot and cold, and depending on where we are, that can move share prices. The fundamentals of this company is rock solid. I think NVIDIA is the clearest beneficiary of the AI build out. We remain in an incredibly supply constrained environment. Now, we don't believe that NVIDIA will be the only supplier of GPUs over the long term. It doesn't have to be for us to make a lot of money for our shareholders in this. But we believe it can sustain over 40% growth rates for the foreseeable future. It's one of the companies with the best financial characteristics that you can find in the market. And none of that has been reflected in the valuation because people are worried about the sustainability of that growth and margins. I think the thing that gives me most confidence is looking at the annual product cadence of this company. It's very clearly still leading the innovation through the performance of his chips.
Great. And you also recently invested in Uber. So it'd be good to hear what the rationale was behind that investment decision and what you see as the main attractions of the ride-hailing company.
Yeah, so Uber has always been a great product, but it hasn't always been a great business. And I think a couple of things are happening now that makes it more interesting to us. The first is that there is a much stronger focus on execution and operational delivery. And that's seen in the progression of the fundamentals, which have marched upwards. So Uber is becoming a good business. And given its asset-light business model and scale advantages, it has the potential to be a very great one. Second, I think, is there's a lot of uncertainty over robotaxis, which I think has been seen as a negative for Uber's terminal value. I think we're a bit more open-minded on the possibilities there. So we're of the view that as the dominant player in a two-sided marketplace, Uber is sort of well-positioned to capitalize on that opportunity. And that rather than being disruptive to Uber's core business, that it could be a big opportunity for it as well. And I think that sort of comes from two parts of it, right? One part is our belief that when you move to autonomous driving, the supply of autonomous vehicles will be fragmented, right? There will be the Waymos and the Teslas, but there will be lots of different autonomous vehicles on the road, and there will be many asset owners that don't have the ability to find customers themselves and to build the apps themselves and just want to use the simplicity of Uber's network to earn money immediately. And I think the second one is that there are actually a lot of operational challenges when it comes to operating robotaxis. So whether it is the cleaning of the taxi, the charging of it, where to stop and pick up, the maintenance of those vehicles. And all of those challenges are best handled by the most efficient player, which tends to be the scale player.
I guess another interesting stock to talk about is Novo Nordisk. So it'd be good to touch on your outlook for the pharmaceutical giant after what's been quite a challenging year.
So we've been wrong on Novo Nordisk. I think our hypothesis when we invested in it is that the GLP is in a class of its own, in that it is where diabetes or high blood pressure was decades ago, in that it is sort of in transition from being viewed as a lifestyle disease, that is obesity is in transition from being viewed as a lifestyle disease, which is primarily a result of bad choices, to being a more complex metabolic disease that is outside of people's control. And that demand for this will just be much, much bigger than anyone has imagined. We've actually been right on the big picture of that, in that the demand for GLPs, I think, has exceeded everyone's expectations, so much so that this has been very supply constrained until very recently. I think where we've been wrong on is the execution of the business, in that the company has made a series of very poor decisions and execution errors, and that has really disappointed. So we are in the process of sort of re-evaluating that part of our investment thesis and rebuilding the confidence in the management there. Just
as we sort of come to the end of this section, I just want to ask you, are there any companies that are currently that you think are flying under the radar, where you're particularly excited about the their growth prospects over the next decade?
Yeah, so the companies I tend to be most excited now are AI related, but none of them are flying under the radar. I'd say maybe On Semiconductors. So On Semi makes power semiconductors and sensing technology. So power semis, it operates at the very high end of power semis. So these are the semiconductors that go into cars and industrial settings where there's very, very high barriers to entry because the cost of it getting wrong is just so high with the recalls, etc. And I think the investment case really relies on three different components now. Firstly, there's a cyclical recovery part of it, which is there was a lot of sort of demand weakness and over ordering during the COVID period, and then tariff, and that's so the automotive sector as a whole is cyclically depressed, and that is set to rebound at some point in time, and On will be a big beneficiary of that. Second, I think there's a very strong structural growth driver here. So the dollar content of their semiconductors that they sell into electric vehicles is 3 to 6 times higher than the dollar content of what they sell into traditional ICE car. And most of this business at the moment is still ICE cars. So there's a lot of there's a long-term structural growth opportunity. And I think also there's a lot of new sort of greenfield opportunities like data centers and factory automation that has not been traditionally served by this company. And then lastly, I think there's an underappreciated turnaround that's going on in this business, in that when the current management team came into onsemi about 5 years ago, they have really transformed the business in that they moved away from the commodity parts of the business. They walked away from about $800 million of revenue. They refocused on innovation. They rationalized the fab footprint and consolidated the fabs and the costs. And they're winning on innovation. And margins are up very significantly despite this company operating at sort of record low levels of utilization. And that, I think, has been underappreciated at the moment.
Thank you, Helen. We've had a few questions come in on the Q&A, so let's kick that off. The first one is about, I guess, how you approach bottom-up versus top-down. So someone has asked, aside from stock picking, how much time do you spend analysing geopolitical trends, such as the breakdown of relations between the US and Europe, China's growing economic dominance, and the decline of the once widely held belief that free trade was the key to driving growth and reducing global poverty? Quite a long question.
Yeah. So we do spend time thinking about that. I think sometimes we get caught in a dichotomy of like you're either bottom up or you're top down. I think the best investors are both. You can absolutely support your bottom up with top down, and I think the best top down investors could benefit from being more bottom up as well. But I like the question because when we think about the top down, it's less in the form of what will the GDP growth rates be, or what would the interest rates be, and more in terms of these very long-term structural trends that we think will matter. So, we talked about some of the structural growth drivers that are driving the economy, but I think a lot of the examples that was mentioned in the question, like the geopolitical aspect, matters a lot for portfolio construction, especially for Monks, where we are sort of less of a purist go growth and more sort of an open-minded portfolio that's trying to balance both growth and resilience. So we do think a lot about those big long-term structural trends. The two that are top of mind at the moment is one is sort of the already mentioned in the question, but the sort of the geopolitical environment, and the other I think is over the last, let's say, 20 years or so, we've really been in a Goldilocks period with the macroeconomic, and that we've had both very strong global growth, and we've had really low inflation or low interest rates, if you like. And that's very unusual in the context of the broader economic history. There's usually a trade-off between the two. And what has happened is that we've been in an environment where growth has been strong, so the top line has been strong. There's been sort of a more broader, open globalization where companies has been outsourcing to cheaper countries, and so costs has been coming down. The profit margins of a lot of companies has been going up, and then risk has been on. And those trends are, if not reversing, they're no longer tailwinds to growth. So the cost of capital is going to be structurally higher than what it has been before. And I think while some of that has been recognized in the valuation of the companies, what I think is less appreciated is how that filters in through the fundamentals of the companies over the next decade.
Great. And another question is about any recent sales. So which companies, or I don't know if you're allowed, what you can talk about, but what companies you've sold out of recently and why?
Yeah, so I think some of the companies that we've sold out of recently has all, so some of it has been because we got the investment case wrong. Some of it has been because, the external environment has changed, and we need to be open-minded and adapt our thinking towards changes in the external environment. So those would be the two main areas. And the other thing that we're trying to do is really consolidate the tail. We've got a lot of the smaller holdings in the tail. Some of those are companies that has not worked and we just got it wrong. And we want to be more deliberate about that and to own up to places where we got it wrong. We just sell because they are a big opportunity cost to the portfolio.
Great. And we have a question on AI. So how do you feel the AI battle between China and the US is panning out? Do you think the Chinese companies will be competitive here?
I think it will be very competitive, yeah. I think I'm actually very bullish about China AI over the long term. That's not to say that we'll find any investable companies that we're comfortable with. But I think China will really lead into the adoption of AI into the real world. And what I mean by that is, clearly China's on the back foot at the moment because they don't have access to the latest AI chips, nor do they have access to the equipment that makes those chips. So they're playing catch up on the semiconductor side of it. But if you look at the adoption of AI, and if you look at just sort of the very first use cases of that, which is autonomous driving, China is really leading on that. Robotaxis are quite abundant in many large cities in China. I tried that beginning of last year when I went back to China. And they're leading because of several things. I think firstly because one of the biggest constraints on broader AI build out right now is energy. And for some reason, we in the West can't it takes very, very long time for us to get planning approval, build out the energy infrastructure, etc. Whereas China can do it very, very quickly. I think they've got over 30 nuclear plants under construction right now. I think US has maybe 1 or 0. And the chances of US building any of that in an appropriate timescale is just very, very small. I think another reason is China is just a little bit more, let's say, open-minded about data and data safety, etc. So its rules and regulations around consumer data and data safety is more lax than what we have in the West. And I think thirdly is all of the restrictions that we have imposed on China has really energized the Chinese ecosystem and it's put a lot of energy in. And the government really has a lot of ability to force everyone to work together. So from all of the smaller companies who are making the machines to the big companies who are buying those and making those semiconductors, etc., the whole ecosystem is connected and they are collaborating in a way that we don't see in the West. right? In the West, the different companies are all competing against each other. So and I think I am optimistic about AI adoption in China. I think where they're struggling with at the moment is to catch up on the manufacturing and make sure they have the things that can make their own chips as well.
And we've had a question come in about the team. So someone would like to know, what is the division of labor between the three managers? So I guess also you'll be slightly forward-looking here as well about where Mike will fit in as well.
Yeah, so there is no division of labor in the sense that we all own the whole portfolio. So all three, or currently four of us, believe in the Monk's philosophy, and we all have ownership for the full portfolio. So it's not split as clearly as like these are my companies and these are Spencer's companies or Malcolm's companies. There is, I guess, we are complementary in our different styles. So on a forward-looking basis, I probably align more closely with the rapid growth side of the portfolio. I spent 7 years in the US growth team before joining the current team. So that would be sort of more of my natural interest. Whereas Mike really comes from the US alpha side. So we've got two different US teams. One is sort of the purest high growth US team, and one is a broader US alpha US team. Mike really comes from that side. So he is of sort of the enduring quality growth type companies. And Malcolm, I'd say, is sort of the experienced guy that's seen lots of different cycles. He's really into sort of the market psychology and sentiment, and he's able to navigate the different challenging times that we face.
Great. And a question has come in about Edenred and Paycom, two relatively recent purchases. And I think they'd like to know your thoughts, or I guess the rationale for those, and whether they're under threat from AI.
Yeah, so Edenred provides payment solutions that give tax-advantaged benefits to employees, like meal vouchers, or they control sort of the mobility purchases that's made by employees, like fuel cards. Now, those two businesses make up the bulk of the revenue. I'd like to say 70% of the revenue. It's a very sticky business that benefits from inflation. There's also a structural growth side, as penetrations of those meal vouchers and mobility cards is not yet mature. So it's about mid 30% for both of those in the markets that they operate. Particularly on the small and medium-sized enterprise side is very under-penetrated, because historically it's been very intensive to serve and to sell to those companies. But Edenred is working on more self-serve capabilities. The snag here is that the regulatory headline has not been helpful to the company, and that the shares have been sort of derailed materially due to the regulatory threats. We did a lot of work on this. It was led by our global income growth team, and we don't think that the regulatory news really affects sort of the growth opportunity of this company on an ongoing basis. So we got an opportunity to buy it at a historic low valuation because of those regulatory threats that are going through. Paycom is a very different business. So Paycom provides payroll and HR software. It's got a very established and strong presence in the SMB sector with smaller enterprises. It's founder-led, and the founder and the CEO owns a very significant part of the business. It's a very attractive industry in that the legacy incumbents of this industry, whether it's the ADPs or the Paychecks, who are losing share, are still growing at mid to high single-digit rates. Right, so Paycom is sort of seen as the Apple of the industry in that it does everything themselves. They build, they don't buy. And it has been for a very long time a darling of the industry. Since then, though, the macro slowdown has really hurt the company in terms of softer pricing. Now that's a temporary slowdown, but also they had a new product, I think it was called the Betty, which was its AI payroll product. And they sort of blotched the rollout of this product. They tried to come at it early before the market was really ready for that. And I think the combination of those two really provided us with an attractive entry point. So at the point we bought it earlier this year, it was trading on a very similar multiple to the legacy players like the ADPs and the Paychecks, but it was still growing much faster. Now, historically, this is a company that grew 20% every year. It's still growing at 10% throughout the period, and the fundamentals are still very strong. So, it's got very small market share, and we think there is a path to much higher market share just in the US without international.
Great. And just our final question, which is just kind of reflecting on 2025. So what were your biggest challenges and opportunities in 2025?
Gosh, so I think 2025, I think, has been an unprecedented year. And I don't know if every year we'll just say is an unprecedented year. But if you think of what we had to face this year, from the DeepSeek sell-off in January to the Liberation Day in April, to then the big acceleration of CapEx spend by the hyperscalers into the year, to then government shutdowns in the US, and then a more recent AI-related wobble in November. So I think it's been quite challenging, to say the least. And I think it's been very sort of abundantly clear that no one has a clue what's going to happen on the big macro side. And so what we tend to focus on what we can control, which is really picking the great companies. And volatility and the macro, they just give us opportunities to buy those companies at attractive rates. We talked of some examples earlier. And I think that's sort of in part why we've been able to reduce the valuation premium without really reducing our growth ambition or the quality of the businesses that we own. So that's the sort of the opportunity side.
Great. Well, thank you, Helen. That's all we have time for today. Thank you for your time and your insights. We have more sessions like this coming up from Baillie Gifford, so keep an eye out for those if you found today useful. Thank you and goodbye.